Hi, I'm Kenton, and this is Kenton Knows. In this video, I want to share some of my thoughts on debt and the strategies around managing debt. I see and hear a lot of experts talk about good debt versus bad debt, or try to teach some new strategy to pay down debt or grow your wealth with some new gimmicky program. What I want to clearly explain in this video is that money is simply a store of value, and it isn't good or bad. The rules of finance cannot be tricked with a gimmick, and neither should you. So allow me to explain why you shouldn't allow these morality judgments or a convoluted new financial scheme influence your financial decisions. This video will hopefully give you the knowledge and understanding, but it is up to you and how you want to apply it. If you like the video, please hit the like button, consider subscribing to my channel, and please leave me any questions below as well. Let's start with the basics of lending and investing. When you have money, a bank encourages you to deposit it at the bank by paying you interest on your deposit. In this instance, you are essentially lending or investing that money with the bank, and the bank pays you an interest rate, which is the return on your investment. The rate is determined by the market and the bank's need or desire to grow the deposits they hold. So, if they need more deposits, they will offer a higher rate to incentivize you to deposit your money at their bank. Bank interest is normally compounding interest, which means that each month you'll receive a small amount of interest, and the following month you will earn interest on the full balance, including the interest earned in the previous month. The bank then loans or invests your money with other people or businesses at a significantly higher interest rate. These loans are normally amortized, so the borrower pays the same payment each month, with the portion of the principal increasing and the interest decreasing after each payment. The interest portion is exactly the same, just in reverse as when you get interest on your bank deposit. Each month, the loan balance goes down, so you pay less interest. Just like when you withdraw money from your bank, they pay you less interest each month. Intuitively, it makes sense that the interest paid each month is less, since the outstanding loan balance decreases with each payment, as a portion of each payment pays down the loan balance. So although you may hear that the bank front loads the loan so you pay more interest up front, that just isn't true. It is a simple interest calculation, and the interest is more in the beginning of the loan because the principal balance is higher. As you slowly pay it down, your interest payments also go down. None of these actions have a morality component to them, and the bank or lender is not doing anything tricky here. These are financial transactions based on clear and simple calculations. Now, let's talk about expected returns. When you make an investment, there is an expected rate of return. If you invest in a certificate of deposit or a government bond held to maturity, the return is virtually a sure thing. But if you invest in an exchange-traded fund, also known as an ETF, or in a real estate investment, there is a higher expected return, and with that higher expected return, there is significantly more volatility in the asset price. The increased volatility is normally correlated to a higher return, which is why you hear higher risk and higher return. These are fairly basic concepts, but they underlie much more complicated concepts, which is why I am briefly explaining them to start. So, how can you use these concepts to actually grow your wealth? I mean, that's really what we all want to know, right? A lot of people say to make your money work for you, but we don't all know exactly what that means. This really is extremely personal, as we all have different levels of risk tolerance and really strong money bias that we may not even be aware of. So it gets way more complicated than if it would be if you were able to determine your exact risk tolerance level and simply make investment decisions with the highest expected return within your tolerance. If you've ever worked with an investment advisor or opened a new investment account, this is what the questionnaires they ask you to take in the beginning is trying to determine. Once they know your risk tolerance, then they can help determine the best investment allocation within that risk tolerance. Now comes the complicated part of balancing debt and investing. If you only concentrate on paying down all of your debt, you are likely missing out on years of investment appreciation. Of course, if you're only investing, you may not have very much to invest if your debt is growing quickly at the same time. So, let's look at this from a finance perspective. To grow your wealth, you need to borrow money at a low rate and invest it at a higher rate. This will grow your wealth, and it is exactly the model banks and businesses use to grow, and you can apply it to your personal finances as well. Seems easy enough in theory. Let's start with debt. Debt secured by real estate is normally the lowest cost of capital or the lowest interest rate people can borrow money. And assuming you itemize your taxes, the interest may be tax deductible, which means the effective rate you are paying is even lower than the rate you are repaying the loan each month. Assuming this is an income-producing real estate investment, this debt is many times called good debt. There isn't anything good or bad about this debt. It's just debt at a lower rate secured by an asset that should be making a higher rate of return than the effective interest rate, which means you are growing your wealth. So you borrowed money at a low rate, invested in real estate, returning presumably at a higher rate. Of course, many of us also have student loans, car loans, credit card debt, or other debt, and many of the so-called experts call that bad debt. So before we just say, pay off all the bad debt, let's decide if that is really the best solution. For instance, I have a car loan at 0% for 5 years, and I have a student loan at 1.625%, which won't fully be paid off for another 9 years if I continue making the normal payments. Spoiler alert, I am going to continue making the normal payments on both of these till they are paid off. I will not even pay $1 extra to either loan earlier than it's due. Since these are not deductible, the interest rate is the effective interest rate. So if I have the money, why wouldn't I pay these off now? That's a good question, so let me explain. When deciding what debt to pay off or what to invest in, you need to compare your effective interest rate on your debt versus the expected rate of return on your investments. Since the debt is usually at a fixed rate, there should be a substantial spread. I prefer about 4% or more between your debt and the investment. Otherwise, I'd say to take the sure thing and pay down the debt. In my opinion, I believe that I can invest in an index exchange traded fund or ETF and expect a conservative return of at least 8 to 10% before inflation. So, if I have a loan that has an effective interest rate of 4% or less, I will divert any extra money I have toward the stock market instead of paying down that debt early. Whether it's $50 a month or the full balance of the loan, the extra money compounds and grows significantly faster at an 8% or higher rate of return. If I concentrate on paying off the loan first and then invest my higher cash flow, I will never catch up. It's mathematically impossible to pay off the debt first and then catch up, because paying off debt with a return of only 4% can't compete with investing in an asset that is growing at 8% or more every year. Let's take a simple example to illustrate this point. Debt-free Dan and investor Irene both have a $300,000 loan at 3% interest for 15 years, and they both have an extra $600 to either pay extra principal or invest. Debt-free Dan pays the extra $600 toward principal and pays off the loan in month 138 of the 180 months, saving just over $4,700 in interest. Wow, that sounds incredible. With the loan paid off early, Dan now invests the full monthly payment of $2,071.74 plus the extra $600 into an investment with a 9% annual return till the end of the 180 months. Debt-free Dan would have the loan paid off and over $132,000 in the investment at the end of the 180 months. Sounds like a good plan, but was it the best plan? On the other hand, investor Irene simply pays the minimum monthly payment of $2,071.74 and invests the extra $600 from day one. At the end of 180 months, both people have the loan fully paid off, but Irene has an investment balance of over $228,000 due to the compounding return of the monthly $600 investment. That's a 42% higher balance than Dan. And what do you think this will mean further into the future? If they both don't contribute anymore, but continue getting an annual return of 9%, the balances in 10 years of Irene will be $561,000 versus Dan at $325,000. In 20 years, Irene will be at $1.375 million, while Dan will be at $797,000. If they both continue doing the same things, Irene will always have a 42% higher balance, which will appear even more dramatic as the values grow. Also, I didn't forget about the $4,700 in interest that Dan saved by paying the loan off early. It just doesn't matter. Dan paid off the loan first and could start investing the loan payment and the extra $600 while Irene still had the loan to keep paying. But Irene also had a large investment growing at the same time. When Irene finished paying off the loan, including the additional $4,700 in interest that Dan saved, Dan had only been able to accumulate an investment balance of $132,000, while Irene had an investment balance of $228,000 due to the years of earning a much higher rate of return. The interest savings sounds good, but it literally means nothing to their net worth, other than perhaps less deductions and higher taxes as a reward for paying it off early. But that is a much more complicated discussion and really not a significant impact in this example. So, debt-free Dan saved some interest, but has a lower net worth for his efforts of paying off the loan early. Don't be fooled by concepts like velocity banking, which try to convince you that paying the loan off faster saves you money. It doesn't. Yes, it reduces your interest, but it costs you so much more by failing to acknowledge the opportunity cost of not investing the extra money in something that can give you a higher return than the interest rate you are working so hard to pay off early. This takes me to our current interest rate environment. I have personally refinanced and taken cash out of all of my real estate properties in 2020 using 30-year fixed loans for the residential properties and have been reinvesting that money in various ETFs. So I have increased my debt with rates at 3 to 3.5%. And since they are all investment properties, my effective interest rate is about 2.5 to 3% after tax deductions. If I can get 8 to 10% in the stock market, which I'm fairly confident I can achieve, I will be growing my wealth substantially more than I would have simply if I left the equity in the property with the lower value loan and kept paying down those loans. Yes, I reduced my cash flow, but if you've followed what I've been saying, you'll understand where this is going. Although I did have some fairly good timing with the market, the money I took out in my refis has already grown more than 25% in less than a year. I don't think that is sustainable. And I realize that this is a short-term result, which will include volatility, but history has shown that the market will surely give me a higher rate of return than the interest rate I am paying. In summary, today's interest rates are incredibly low, so take advantage of the low rates, but be sure you are investing in assets that will give you a higher rate of return. I'm not saying to increase your leverage to the point of being uncomfortable or risking your family's future. I'm simply saying don't pay extra towards your principal and invest the difference in a higher returning asset. Reduce your expenses where you can so you can invest extra while you are younger. The longer your money has to grow, the more it will compound and the faster you'll see your wealth grow. Regardless of what you've done in the past, make today the day you will do better going forward. There aren't any financial gimmicks that beat math. It is very simple. Invest at rates higher than your loans. If you can't find investments that return a higher rate than your loan, pay off that higher rate loan first. It's not complicated, it's just math. So don't fall for the financial gimmick. There is a reason these schemes aren't used by corporations or discussed in finance classes. It's because they fundamentally don't work if you apply simple math to the concepts. I hope this gives you a little more understanding of how to prioritize paying down your debt or investing, and please stop placing moral judgments on money. It isn't good or bad debt. You may have made a good or bad decision in the past, but all you can do now is take action today. Please like this video, subscribe to my channel, and leave me a comment as well. Also, please be sure to check out my other videos, and thank you for watching Kenton Knows.